There are many reasons why the relative strength index quickly became so popular with traders. Once understood and correctly applied, the RSI has the ability to indicate whether prices are trending when a market is overbought or oversold, and the optimal price to enter or exit a trade. That's why in today's video, we'll discuss the most important 10 trading rules and strategies you need to know about the relative strength index. Number 1. Use RSI overbought and oversold levels only in combination with support and resistance levels. A reading of the RSI above 70 or below 30 isn't necessarily an invitation to enter a trade. In some instances, an asset may remain overbought or oversold for an extended period of time if the price trend remains strong. Before acting on overbought and oversold readings, examine price action and make sure you identified all major support and resistance points on your chart and take signals from these key areas. Also, RSI buy and sell signals should always be evaluated within the context of the current trend in order to minimize risk. For example, if a price is forming a strong uptrend, you should ignore oversold readings that oppose the current trend. Always remember that RSI overbought and oversold areas as a solitary signal is not entirely reliable and require complementary tools to strengthen the signal. Number 2. Use the RSI 50 level to determine the dominant trend. The RSI displays the momentum of the price as a value either above or below 50. When the RSI is above the 50 line, the price has upwards momentum, and when the RSI is below the 50 line, the price has downwards momentum. When the RSI is crossing the center line, the momentum is switching from one direction to the other. And, as in the previous examples, always consider price action when taking a trade. Here we have a trend line breakout with this candlestick closing above the resistance line. The downtrend was too strong to be reversed so easily, so I wouldn't trust the resistance breakout. The RSI confirmed that the resistance breakout was valid because it has moved up from the oversold area to the 50 level and then broke the 50 level. This is how the RSI center line can help you to confirm your trade setups. Number 3. Add the moving average to the RSI to pinpoint entries and exits. The RSI can be used to provide entry signals during a trend, and to get the signals, a moving average is applied to it. Once you add a moving average on the indicator, you can take crossover signals, but not blindly. Again, consider market context, add the major levels on your chart, and take the signals in the direction of the main trend. A crossover between the RSI and the moving average is a good signal when markets are trending. When price is in a range, this approach would lead to a lot of false signals. From my experience, a longer-term moving average added to the RSI will work better than a short-term moving average and will produce fewer false signals. So instead of adding a 10 moving average on the RSI, for example, I advise you to apply a 50 moving average or a 100 moving average period and start from there. You can then decrease the length on the moving average after you backtest the signals. Number 4. Use RSI regular divergences to find reversal points. RSI regular divergences can be either bullish or bearish. A bullish divergence occurs in a downtrend when the price action prints lower lows that are not confirmed by the RSI. This indicates a weakness in the downtrend, as selling is less urgent or buyers are emerging. When the RSI fails to confirm the lower lows on the price chart, it makes higher lows. A bearish divergence occurs in an uptrend when price action makes higher highs that are not confirmed by the RSI indicator. This indicates weakness in the uptrend, as buying is less intense and selling or profit-taking is increasing. As with the positive divergence, the RSI fails to confirm the higher highs on the price action by making lower highs. The RSI regular divergence can be used as a reversal signal to pinpoint the end of a price swing, and is more effectively used in conjunction with other trading techniques such as trendline breakouts, support and resistance breakouts, and candlestick patterns. Number 5. Use RSI hidden divergences to identify high probability pullbacks. A hidden divergence on the RSI occurs when the trend holds up despite the momentum going against it, offering a continuation signal. Hidden divergences can help you to identify pullbacks that have a high probability of working out. In an uptrend, there is a hidden divergence when the market is making higher lows, but the RSI indicator is making a lower low. And in a downtrend, there is a hidden divergence when the market is making a lower high, but the RSI indicator is making a higher high. Remember that a hidden bullish RSI divergence only happens in an uptrend, and the trend should continue to the upside, whereas a hidden bearish divergence only happens in a downtrend, and the trend should continue to the downside. A common mistake that many traders make when trading is the minute they notice a divergence, they take the trade accordingly. In order to identify the pullbacks effectively, a hidden divergence on the RSI is more powerful when used in conjunction with trendline breakouts, support and resistance breakouts, and candlestick patterns, as in the case of the regular divergence. Number 6. Combine RSI with a leading indicator for better results. In order to achieve a proper balance in your trading, you can mix the lagging signals coming from the RSI with a leading indicator. The reality is that the RSI is a lagging indicator, which follows price movements and doesn't have reliable predictive qualities. Leading indicators, on the other hand, are able to anticipate when major moves in the market would occur. The most effective leading tools you could use in combination with the RSI are pivot points and Fibonacci retracements. For example, plotting pivot points will allow you to know in advance several key levels for the next day, and if the price reaches the main pivot point, for example, there will be a reaction, a rejection, or a breakout. A high probability signal would be a hidden divergence on the RSI occurring at the central pivot point for the day, or a regular divergence occurring at the R2 level. Or you can use a Fibonacci retracement level with the RSI. You can enter after RSI hidden divergence in an uptrend when the price rejects an important Fib level. Or you could combine an oversold RSI with the 50 Fibonacci level, for example. The key is to find confluence between leading and lagging tools. Number 7. Use RSI trend lines to find optimal entry points. An overlooked method of using RSI is the use of trend lines directly on the oscillator itself, in much the same way they are used on the price chart. By connecting rising swing lows on the RSI in an uptrend or lower swing highs in a downtrend, you can find trading opportunities. Because RSI measures the surge in closing prices, when RSI changes direction and either breaks above or below a trend line, a significant move in price can result. I strongly advise you to use RSI trend lines on higher timeframes. The rules of this approach are straightforward. You only need to connect the most recent RSI peaks or valleys with a trend line and to search for a breakout, which will warn you that the market has lost its steam and the prevailing trend has lost its momentum. Also, don't use RSI trend lines as a reversal signal. Here's a common mistake. Many traders, when they spot a strong uptrend, for example, and identify a trendline breakout on the RSI, they go short. This could work, but a safer entry would be to concentrate on breakouts in the direction of the main trend. In this case, focus on breakouts to the upside on the RSI. Number 8. Use RSI in combination with candlestick patterns. For example, you can see here a bearish engulfing candle combined with a bearish RSI divergence at a double top. So as the price is testing the double top, the RSI indicator is showing a clear bearish divergence. We see a strong reversal signal with price printing a bearish engulfing candle. This tells us that there has been a shift in supply and demand at this level. The presence of the bearish engulfing candle at a double top with a bearish RSI divergence is a strong set of criteria for placing a short trade. In this other example, you can see a bearish pin bar at another double top with overbought RSI. So with price testing the resistance level and with the RSI in overbought territory, this means that price is vulnerable to a reversal. The formation of the bearish pin bar would then confirm the trade and offer an entry point. Pin bars, similar to engulfing candles, represent a strong shift in the underlying supply and demand balance. When you combine RSI readings with candlestick patterns for trade entries, you obtain a more powerful signal. Number 9. Use RSI on multiple timeframes for a better price analysis. An effective RSI trading strategy involves a multiple timeframe approach. The underlying idea is to go with the larger theme on the higher timeframe and then drill down to the lower timeframe in order to gain better timing and to increase your risk-reward ratio. A simple way to execute an RSI multiple timeframe analysis is to use the same settings on two different timeframes. You can then catch the moment when both the higher timeframe indicator and the lower timeframe indicator come from oversold or overbought area and are moving in the same direction. Number 10. Adjust the lookback period to make the RSI more or less volatile. You must always tweak your RSI settings depending on your favorite time frame and trading style. A shorter RSI period below 10 will be very volatile and will generate a lot of signals, but will have a lower level of reliability. A longer RSI period above 20 smooths out the plotted line and will generate fewer and potentially more accurate signals. RSI is considered overbought when above 70 and oversold when below 30. These traditional levels can also be adjusted to better fit the market you're trading. Rising the overbought to 80 or lowering the overbought level to 20 can help you to reduce the number of signals. The truth is that there is no right or best period, and being consistent is more important than the exact number itself. The selection of the lookback period should be based on your data, time horizon, trading style, and the way you use the RSI in general. If you got any value from this and learned something new, leave us a like to show support, subscribe to our channel and click the bell icon to stay in touch with new uploads. Until next time.